Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. European stocks are mixed as the continued First Republic turmoil deepens concerns about regional banks. The Nasdaq and U.S. futures climb on strong tech earnings. Meta sales top estimates post-market. Amazon reports today. Plus, Barclays is trading higher after its corporate and investment bank top estimates amid the recent banking turmoil.
The UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually corporates putting deposits with us.
We'll get more from Francine's exclusive interview later, and that is precisely why I'm here, and she is currently not. Of course, she was just over at Barclays talking to the CEO there. All right, when it comes to these markets, European stocks just barely pushing higher. U.S. stocks, those are doing better, but it was 2 consecutive negative sessions counting yesterday. It's those fears over First Republic. We are buying some more now. It's the tech earnings that are fighting through the noise. Meta outperforms. Then 5-year yields, those are climbing higher yet again. The buying has been concentrated on the belly of the curve. Again, it's this idea, is there more of a Fed pause? Do they stop hiking sooner? Do they start cutting if we are still concerned about banking turmoil? Finally, Bitcoin, that's having a good morning. It was trading near 30,000 at one point, but liquidity is thin, so it tends to bounce around more. But even so, it is clear that there is some risk appetite in this market. Looking across regions, again, it is a mixed bag. The catalysts are that of earnings. We did have some disappointments when it came to Deutsche Bank, so the DAX not performing as well. Their FIC trading not keeping up. Yes, we did have a strong Barclays results, but still when it comes to the FTSE 100, that is more or less flat. CAC and FTSE MIB, those doing better, up about 0.3%. Now, I mentioned that Meta earnings were really good. We're just getting the print on the pre-market trade. I want to show you that 11.33% is where we stand on the pre-market trade for Meta. Their sales coming in really strong. Advertisers, they want to spend. They want to spend with Facebook. Again, that doesn't seem like an environment where we're necessarily in a recession if these corporates are willing to do that. But Meta also talking about the fact it means that they can spend on some more of their more growth areas, things like AI, which is the buzzword for every company these days, things like AI and virtual reality. So that's the Meta share price read. But let's go back to the Barclays story. Shares there are higher this morning. The UK lenders' fixed income revenue beat estimates. Francine Lacqua spoke exclusively to the CEO moments ago.
It was a very nice set of results this morning that we were privileged to publish. What I liked about the results, Francine, is not just the numbers, but the composition of it. And FIC was an important part, but not the only part. So if you look at the numbers top line, 2.6 billion of profit before tax in sterling. It's about up 16%. Revenues up around 11%, 7.2 billion pounds. An excellent ROTE of 15% across the group. Capital ending where we would like it to be. One of the, a record quarter of performance for the bank, and the second biggest for the corporate and investment bank. So all very good. Now, what drives it? And that's the important part. And for us, it's actually been the workings of many, many quarters of building this. And there are 2 parts I'd like to highlight. The first is the investments which we've made in our business. Whether it's in our credit card portfolios in the US, where we acquired a Gap portfolio of 10 million customers, and whether it is in our markets business, where not just investment in technology and people and fixed income, but also in our trading systems, but also in financing, both in fixed income and in equities prime, which continue to help us in this environment.
So if you look at FIC trading, are you expecting this momentum to go into the second quarter?
So we hope to keep the market share that we have gained with our clients over a number of years to persist. We've broadened and deepened relationships. The actual dollar amount of revenues, of course, goes up and down with volatility in the markets. And that's much, much harder to predict. But what we try to do is to have that capability.
So is this a kind of diversification from the rest when you look at your main drivers going forward?
Well, what we hope is that we have a lot of drivers. and that at the right times in the market that they all are there and they click. So, the first quarter of this year was a lot about the bond markets. Interest rates went up and down with the stuff in banking that happened in the US. The first quarter a year ago was about equity vol, single stocks. And then our equity business was ready to capture that. So that's how we try to do it, have a full-fledged capability.
So when you look at March was pretty incredible when you look at the banks, starting with the SVB and then Credit Suisse. Does that mean that you had deposits, that people come to you because they were afraid of other banks?
So the UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually corporates putting deposits with us. On the consumer side, it dropped a little, but that seasonality we expect as people pay their income tax bills and draw money from their accounts to do that. So the deposit franchise has behaved extremely well and predictably. But it's also, for us, it's a deposit franchise that we've built over decades, right, with a very nice mixture of individuals, of corporates, small businesses.
The Barclays CEO there. And we're going to have more of that exclusive interview on Bloomberg UK in about 30 minutes' time. We're also getting a read now on the pre-market trade for First Republic. It is up, but it's up slightly compared to the drop we've seen. So up about 7.5%. Now, usually that's a lot, but these shares have fallen 64% in just the past 2 days, taken together even more than that. So its value has been halved and then halved again and then halved again quite significantly. But still, shares up pre-market. But yesterday, their stock was halted 16 times. Its price continues to lurch lower. As I said, it dropped 30% on the day yesterday. U.S. regulators are also said to be weighing limits to the bank's access to borrowing from the Fed. For more on this, let's bring in Bloomberg's Valerie Teitel. Valerie, is there any sign of a rescue deal for First Republic?
Look, we're just sitting and waiting for a buyer to appear, and the lower the stock price goes, the more likely is someone's going to swoop up and buy it. But it seems like there is a bit of hesitancy from these potential buyers because they want the government involved somehow in order to protect them, from any financial risk of the losses being more than they expect. So it's all about, where do these losses sit? Are they going to sit in the private sector on the bank's balance sheet who buys them, or are they going to sit with the FDIC if they take them into receivership? So far, it seems like the government is a bit demurred to act in terms of helping with a restructuring solution. So it's become a bit of a standoff between these potential buyers and the FDIC, who doesn't seem to want to give any assistance.
What are their options in terms of assistance, in terms of, I guess, making this more attractive to banks?
Well, look, a lot of the options seem to have been closed now. Remember, it was a few weeks ago, it was rumored that the Fed might expand their BTFP facility in order to take more different kinds of collateral, because First Republic doesn't really hold that many treasuries it can use to lend against with that new facility. But that seems to be, far gone now with the stock price trading so low. And then we heard from the FDIC themselves, they're looking to potentially downgrade their assessment of the bank, which would prevent it from accessing the Fed's discount window at all, which would be, close the doors on the bank essentially. And, it's very unlikely the FDIC would give uninsured depositors some special treatment. So it seems like the option for the FDIC is to put it in receivership, but they don't want to do that because then they sit on the losses. And remember, they're already sitting on $30 billion of losses from the first 3 bank failures.
Quickly here, Valerie, and I know this is a big ask to do this quickly, but what has the market reaction to all this been?
Well, thankfully, yesterday, the stock price plunge didn't drive a wider risk-off move. But let's remember, the issues facing First Republic is that its business model just does not make money with a Fed funds rate at 5% and their loan book making less than that. And that is something that is shared with other regional banks around the U.S.
All right, Valerie, thank you so much. That's our markets reporter, Valerie Teitel. Now, coming up, Sanofi profit beats estimates as the French drug maker's blockbuster treatment advances. We're going to be speaking to the CFO, Jean-Baptiste at Chatillon, next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Sanofi's profit rose more than expected in the first quarter. That happened as the French drug maker's blockbuster therapy, Dupixent, gains market share. The company's best-selling product is used to treat ailments ranging from asthma to severe eczema. We're joined now by Sanofi CFO Jean-Baptiste de Chatillon in Paris. Jean-Baptiste, great to speak with you this morning. It's clear that Dupixent, a really big growth driver here. But when you look at the rest of the year, what do you see as the biggest contributors to growth? Where do you squeeze that out for 2023?
Yeah, thank you, Danny. It's really an interesting start of the year with this top-line growth of 5.5% at constant exchange rate, and with an EPS growth, double-digit, 11.9%. We have really a strong start in 2023. But as you say, we have now several growth drivers which are showing up. Of course, Dupixent with a new extension to a new indication, COPD, you know, this chronic bronchitis, which is really a major cause of death around the world. And we are going to bring, on a fully unmet need, Dupixent to this indication. And so that's a great news for patients. But beyond this, and to answer your question on the full year, we will be presenting new growth drivers today on incoming events during the year to present the progress on our pipeline. We are launching this year three important products. We just mentioned Altuvio in hemophilia. We are launching Beyfortus, which is addressing another huge unmet need with RSV. You know, this virus, which is the first cause to bring babies into the ICU. And we have a product which can really prevent this on a massive scale. So great news for patients coming during the year 23, which are growth driver for the rest of the year, but also great news coming on our pipeline.
Yeah, well, when it comes to Dupixent, you mentioned the COPD, the use case for that. What does the timeline look like? How soon could you file for approval, regulatory approval, when it comes to that use case?
Well, that's a great question, and we have good discussion with the regulator. So answer coming later when we have finalized those discussion. But of course, when you have a major unmet need like COPD, and there's no available drug to really address this issue, we have great hopes that it will be a quick resolution to go to market with this indication.
Jean-Baptiste, as someone who works in TV, I love a good teaser, which is exactly what you just gave us. Look, the market view is ahead of your 13 billion euro target when it comes to your blockbuster drug, Dupixent. Why not raise your peak sales estimate?
Yeah, well, that's a great point. And we are dimensionalizing. We are looking into it. But, you know, many people now have very good estimate on where it can go. I think for us, and we'll come back later on in the year with our best thinking about it, but for us, it's also looking at the broader pipeline of immunology. Dupixent is just the beginning of our leadership in immunology. And we'll present, even today, some advancement on other products in immunology, like our CD40, frexalimab, which will show what is the future beyond Dupixent. Quite interesting.
When it comes to Zantac, of course, it's the heartburn medication that was drawn from several markets with fears of contamination with a likely carcinogen. Last month, the California court allowed a Zantac case against GSK to go forward. When you look at your exposure to some of these issues, what is, as you see, the trial risk involving Sanofi and Zantac? Are there more risks of that?
Well, Danny, I think you use the right word by talking about fear of a risk. But as you know, there is no medical evidence, no scientific evidence of any link between this drug and any cancer. And that was pretty well described in a historical ruling from the Lombard case. And after this Lombard case, really, for us, we don't see this issue around Zantac impacting in any case our strategy or our business. So we're just on a business as usual trend. So it's not is not a major issue for us.
Jean-Baptiste, before we go, this one's a little bit out of left field, but look, AI has really been the buzzword this earnings season. We've seen, I mean, at least the tech companies mention it, at least 50 times in their call. When you think about the pharmaceutical industry as this technology rapidly evolves, what do you think will be the biggest disruption to your industry?
Well, it has started already. Sometimes maybe this industry, we don't talk sufficiently about what we do in tech. But let's just discuss about Dupixent. How did we identify what were the indications where we had the most chance with this drug to succeed? Well, with AI-driven algorithm. And that's quite interesting when we apply to our research programs. When you have a molecule where you see it's effective with a great safety profile, you can then find out or ask AI to come back to you with where it could be most efficient for patients. We use it. It's already real
Very
in our
interesting.
company.
All right, Jean-Baptiste, we're going to have to leave it there. Really great speaking to you today, Sanofi CFO Jean-Baptiste de Chatillon. Now, coming up, Meta shares are up pre-market, a rebound in digital advertising sales, and forecasts better sales ahead. More on that next. This is Bloomberg. Let's get your first word news. With that is Leanne Gerrans. Leanne.
Danny, good morning. The U.S. House has passed a debt limit bill aimed at averting a catastrophic U.S. default in a political victory for Speaker Kevin McCarthy. The vote puts pressure on President Joe Biden, who opposes the legislation's sweeping spending cuts, to open talks with Republican leaders. The bill passed by 217 to 215 votes, but has no chance of clearing the Democratic-controlled Senate. Now, Bloomberg has learned that Turkish President Recep Tayyip Erdogan has cancelled a day of campaigning appearances after falling ill during a live TV interview. We understand he will skip the opening of a power plant built in cooperation with Russia, instead joining via video conference. Erdogan is facing his toughest election in 20 years, with 6 opposition parties joining forces to unseat him. Chinese President Xi Jinping has spoken with Ukraine's Volodymyr Zelensky for the first time since Russia's invasion began. Readouts of Wednesday's call suggest there were no major breakthroughs, though President Zelensky's office said the hour-long conversation was productive. Xi reportedly told Zelensky that negotiations are the only way out of the crisis. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. All right, a quick check on Meta in the pre-market trade, up more than 11% off the back of strong earnings. Advertising spend, that is still going strong. Meta saying that they're also able to spend when it comes to things like AI. Joining us now to discuss is Matt Bloxham, tech analyst at Bloomberg Intelligence. Matt, what was the takeaway for you?
Yeah, I mean, as you pointed to there, the resilience of ad spending, I think that's been a surprise across the board this quarter. And for Meta, after 3 quarters of top-line decline, a rebound, small but growing 2.5%, was a strong signal that, having had a lot of pressure from TikTok and having to adjust to the changes in Apple's privacy rules, that they've actually got the kind of core ad business back under control, and it's got some positive momentum again, particularly in Instagram, where their Reels product is starting to kind of get more ad impressions and more user time on the platform. So encouraging signs.
Is there a contradiction between Meta and Zuckerberg, who says this is the year of efficiency, we're cutting down on costs, and discussions of spending on AI and growth there and growth in virtual reality?
I don't think that, I mean, certainly if you've been on the wrong end of layoffs, then you're going to be asking that question. But I guess part of this is that there needs to be a big pivot in where they're employing people. And perhaps they've just had too many people in the wrong parts of the business that aren't kind of driving productivity or sales. And they need to double down on the AI and the metaverse investments, which are expensive. People there are probably even more expensive than other parts of the business. So I think it's a bit more of a shift in where they're their resources are focused rather than bringing the entire kind of operation down a peg or two.
About a minute here, Matt, but I know you cover other companies exposed or in the digital advertising game. Was it improvement across the board?
I think generally, I mean, we've seen quite a few of the ad agencies report in the last week or two, including WPP today. Generally, the ads industry has been holding up better than expected. The agencies have still been quite cautious about the full year outlook, though, and I think we've heard some of that with Google earlier in the week too. So I think, you know, it's a bit like, you know, make hay while the sun shines at the moment, but don't get too carried away about the second half of the year because we might see some bigger headwinds as campaign budgets are cut.
Right. All right. Yeah, certainly those fears of recession alive and well. Matt, thank you so much. That's Matt Bloxham, our tech analyst at Bloomberg Intelligence. Now, coming up, we're going to get more from our exclusive interview with the CEO of Barclays. This is Bloomberg. Good morning and welcome to Bloomberg UK. I'm Danny Berger in London. You're looking at a beautiful shot of the city this morning. Now, this week, we're going to focus on bank earnings, financial stability, and our exclusive interview with the chief executive of Barclays. Now, shares are higher this morning as the UK lender's fixed income revenue beat estimates. We spoke exclusively to the CEO earlier.
It was a very nice set of results this morning that we were privileged to publish. What I liked about the results, Francine, is not just the numbers, but the composition of it. And FIC was an important part, but not the only part. So if you look at the numbers top line, 2.6 billion of profit before tax in sterling. It's about up 16%. Revenues up around 11%, 7.2 billion pounds. An excellent ROTE of 15% across the group. Capital ending where we would like it to be. One of the, a record quarter of performance for the bank and the second biggest for the corporate and investment bank. So all very good. Now, what drives it? And that's the important part. And for us, it's actually been the workings of many, many quarters of building this. And there are two parts I'd like to highlight. The first is the investments which we've made in our business. Whether it's in our credit card portfolios in the US, where we acquired a Gap portfolio of 10 million customers, and whether it is in our markets business, where not just investment in technology and people and fixed income, but also in our trading systems, but also in financing, both in fixed income and in equities prime, which continue to help us in this environment.
So if you look at FIC trading, are you expecting this momentum to go into the second quarter?
So we hope to keep the market share that we have gained with our clients over a number of years to persist. We've broadened and deepened relationships. The actual dollar amount of revenues, of course, goes up and down with volatility in the markets. And that's much, much harder to predict. But what we try to do is to have that capability.
So is this a kind of diversification from the rest when you look at your main drivers going forward?
Well, what we hope is that we have a lot of drivers and that at the right times in the market that they all are there and they click. So, the first quarter of this year was a lot about the bond markets. Interest rates went up and down with the stuff in banking that happened in the US. The first quarter a year ago was about equity vol and single stocks. And then our equity business was ready to capture that. So that's how we try to do it, have a full-fledged capability.
So when you look at March was pretty incredible when you look at the banks, starting with the SVB and then Credit Suisse. Does that mean that you had deposits, that people come to you because they were afraid of other banks?
So the UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about 10 billion pounds during the quarter. And a lot of that was actually corporates putting deposits with us. On the consumer side, it dropped a little, but that seasonality we expect as people pay their income tax bills and draw money from their accounts to do that. So the deposit franchise has behaved extremely well and predictably. But it's also, for us, it's a deposit franchise that we've built over decades, right, with a very nice mixture of individuals, of corporates, small businesses.
The CEO of Barclays speaking exclusively to us earlier. Coming up, we're looking ahead to more UK bank earnings next week, how they have fared this past quarter amid the global banking turmoil. We'll discuss all of that next. This is Bloomberg.
Top-line growth has been really strong for us, so we're up 13% on our top-line growth. We were up double digits last year, so the overall performance of the business has been fantastic. The profitability is now up at the levels we last saw back in 2015, so a long period of time since. Interest rates going up has clearly been a help in that, but also we have seen a lot of client demand as particularly the Asian markets now pull through the COVID period and start to look forwards.
Does that mean that even if the Fed, the BOE, stops hiking, that interest income margins will have peaked, or is this not the peak yet?
So last year, our interest margin was about 1.4%. We have said this year we think it will be about 1.7%, and we have said next year we think it will be about 1.75%. So we are sort of nearing a higher level, but still on the rise.
So if everything looks good, profitability is still strong, your figure of $5 billion worth of capital returns by 2024, would you say that's a conservative figure then?
Well, we need to start somewhere. So $5 billion, we are roughly halfway through excuse me, in terms of what we have announced so far. $5 billion coincidentally will be the amount that back in 2015 we raised as a rights issue, so essentially it will be handing that money back. But I'd say overall we're well on track for delivering the $5 billion.
Are you still fearful that the worst of the contagion, again, emanating from a market far away from yours, but are you fearful that perhaps that's not over yet?
There obviously have been two major issues in the sector. But actually, for us as a business, we have actually seen our numbers stay incredibly solid. So our deposits have remained very, very stable throughout the period. So not that anybody is totally insulated from something going on in the sector, but I do think the fact our businesses are more based in other parts of the world. We are very spread. Our deposits are spread across many countries, many different types of client. I think actually our business model is a very robust business model for this sort of circumstance.
Well, almost, I mean, perversely, does it help you? And I'm thinking here specifically of Credit Suisse. Did you see flow that was clearly from them, clearly from their clients, especially in wealth management, fleeing Credit Suisse and coming into Standard Chartered?
I think if you look back over the last probably 6 months or so, particularly last year, we saw strong growth in our assets under management. I think some of that was probably helped by some shift away from some banks like that. So I think this will be a flight to safety. I think the bigger, more robust institutions that have been around a long time, are trusted, will be the beneficiaries of this.
In January 1st, Abu Dhabi Bank said it had explored a deal with Standard Chartered to buy it. Since February, it said it's no longer planning to do so. Have you had any conversations with them since? Is Standard Chartered, is the future still an independent bank?
We have had no discussion with them whatsoever. We are an independent bank. We are motoring well under our own devices. We're very pleased with our performance.
Standard Chartered CFO Andy Halford speaking to me there after releasing its earnings yesterday. Now, Standard Chartered and Barclays are just two of the biggest London-based banks that have reported earnings this week. Investors at this point are seeking more clarity on the health of the global economy and if there are any signs of fallout from the turmoil in the banking sector. And of course, we can't forget the Brexit impact either. Bloomberg recently revealed that Paris has been seen a surge, in top-paying bank jobs. So we have a lot to cover here. Joining me now to do so is our city editor, Catherine Griffiths, and William Shaw from the Bloomberg's finance team. Thank you both so much for joining today. Will, let me start with you just when it comes from what we've heard from the banking sector so far, specifically in the UK. Barclays, Standard Chartered, just heard from both of them. What have been your big takeaways?
So like you were saying, this is the first real indication of what negative effects banks might have experienced from SVB and Credit Suisse going down last month. The immediate answer seems to be everything's looking pretty good. So if you look at Barclays, their FIC traders have beat estimates. Their fixed income traders have seen revenue up 9% to £1.79 billion in the first quarter. Now, that's actually compared to analyst estimates of a drop of 11%. So that comes against a backdrop, effectively, of high interest rates, which are creating volatility in the market and creating opportunities for traders to bet on what rates and what inflation are going to do next. Standard Chartered as well has had very positive results. So yesterday we saw they'd had their best quarter since the first quarter of 2014. Again, that's partly a function of interest rates and partly it's about economies in Asia accelerating their exit out of COVID-related lockdowns. We've got NatWest, HSBC and Lloyds now to watch for further indications.
One of the things at Barclays that came on strong were its deposits. It saw an increase when the fear at the moment for many banks is deposit flights. I just want to quickly play for both of you the comments from the CEO and get your thoughts. Take a listen.
The UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually corporates putting deposits with us.
So, Will, I'm going to start with you again here. Why has the UK been more insulated?
So there's a couple of reasons for that. I mean, first of all, if you look at what happened to SVB, so smaller banks like SVB in the US they received a carve out from stress testing requirements, which meant no one ever got an indication of what would happen to a firm like SVB when borrowing costs rose sharply. The UK never provided that kind of carve out, and therefore they haven't faced the drama that banks in the US have. Regulators point to Virgin Money, which is an equivalent sized bank to SVB in the UK, and there are no obvious problems with Virgin Money.
Catherine, does that mean regulators are off the hook if we're not having that deposit flight like is occurring in the US?
I think they wouldn't want to say this definitely publicly, but I think privately they do slightly feel quite pleased with how things have gone in the UK, as we saw the dramatic difference in SVB in the US and SVB here in the UK, which was sold to HSBC over a single weekend. They would say about that it was possible to sell the UK business because it was in far better shape than some of those US regional lenders. And they would trace that back to things like making sure that the UK part was subsidiarised, so it was entirely regulated here in the UK from last year, and that made it in a much better position to enact the sale.
Well, Andrew Bailey did raise the prospect of increasing the level for UK deposit insurance to $85,000. Jeremy Hunt, if I'm not mistaken, followed up with a similar comment, coincidentally or not, at very similar times. What is the likelihood of that happening?
I think it's really quite likely that they will raise the level, the £85,000 here in the UK. It's lower than in the US, where it's $250,000, for example. But the question, of course, is to what point will they raise it? There's been talk about whether we could potentially guarantee all deposits in the system. It just wouldn't work in a country like the UK, where financial services and deposits are such a big part of the economy. It might threaten our credit rating as a country, potentially. So they've got to find other ways to inject more confidence into the system. So we'll definitely see, I think we'll definitely see the limit being raised, but we'll see other measures being taken to try to make sure that when there's the next problem, as there inevitably will be, and of course it won't look the same as SVB, it will look different in some way, that people don't immediately rush to take their money out, because that's the huge challenge we now face in this internet age. SVB in the US, people took out the amount of deposits that you might ordinarily think in a problem time in a month. They took them out in a matter of hours.
Right.
You can never kind of deal with that apart from on the other side of things, which is about confidence and making sure systems work well.
And I guess now you can also tweet about it. You can make a TikTok that you're getting your money out. So that sort of word travels so much more quickly. Will, how would big banks feel if they had to put more into a deposit insurance fund? Would they be upset with regulation like that?
Well, so John Vickers, who's one of the architects of UK financial regulation, has told Bloomberg that these changes to deposit guarantees would require higher capital charges on banks. Obviously, banks don't like their capital charges. It limits the amount of money they've got to invest elsewhere. It's likely something that would cause a lot of consternation in the banking sector. So there would probably be a discussion, you know, what's more important for us here, to make sure that we're protecting retail consumers, or to appease the lenders on the amounts of capital reserves that they need to hold, and making sure that they're not being prohibited from doing business unreasonably.
So we're going to, in just a bit, talk with our tech reporter about the UK CMA turning down or blocking the deal between Microsoft and Activision. So I don't want to get into the details too much. But, Catherine, there has been this ongoing fight of whether London can reign supreme in terms of a financial center, whether companies want to list here or list in the US. Is there some element of discouraging if you see the UK financial authorities blocking a very large deal?
Well, that's certainly what the folks were saying yesterday, that it was terrible and it clearly London didn't want growth, and it seemed a very partisan and quite emotional statement in my view at least. Of course, all these things feed into people's decisions about where they're going to list, and yesterday there were several senior city people who gave evidence to Parliament about this issue. And what they said time and time again is you have to have different things that are changed in order to improve the whole ecosystem. So it really can't just be about straightforwardly folks get paid more money in the US or there's a higher valuation on the stock. Those come from other factors. So there's a higher valuation on the stock because there's more liquidity in the US. We need to bring that liquidity into the UK market. One of the things that comes across time and time again is how you harness the huge pensions industry we have here into being more effective investors in UK companies.
If I'm not mistaken, you both wrote a piece on this, is that right? Okay, we have the perfect two people to talk about that. Well, what will it take to get what the folks you and Catherine spoke with about getting that money into London? What does it take in terms of regulation or investment?
I was struck yesterday a bit by the fact that these three sort of senior city figures speaking in Parliament seem to be much better at identifying and analysing the problem than suggesting like any obvious solution. I mean, in order to make a change like this, you need Parliament to give new powers to the Financial Conduct Authority in order to assist with that.
Okay. So just to wrap things up, and Catherine, I feel like this is an impossible question, but you touched on this a bit. What are sort of the next crises that regulators have their eyes on? What is it the next thing that they're thinking about tackling, or is it just taking care of the problems we've seen over the past month?
Yeah, that is an impossible
Yes.
question, and as everyone always says, I'd be a hedge fund manager if I knew the answer. I mean, there are certain sort of, flashing lights in the economy which are easier to identify. So some of the US banks talked about commercial real estate being potentially quite a problem. The US debt ceiling is obviously causing huge drama across the world. But really that more sort of philosophical point about what's the nature of the next crisis is very difficult. I don't think anyone really would have identified the SVB crisis particularly, although as we started this discussion, UK regulators did in fact see the sort of concentration risk and some of those issues around this particular group of customers. But I do think this new world of instantaneous withdrawals of deposits creates a real problem across the board. So whatever the actual pressure point turns out to be, it's this point about if we want a world where we have fractional banking, where you believe in people being able to put their money into banks and take it out whenever they like, you've got to deal with the fact that people can do that in an instant now, and that's a very new thing.
It's so true. Hey, Catherine, Will, thank you both so much for joining this morning. Really fascinating conversation. That's Catherine Griffiths, our city editor, and William Shaw from Bloomberg's finance team. And be sure to subscribe to Bloomberg's In the City podcast on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. Coming up, is the game over? The UK puts Microsoft's $69 billion takeover of Activision Blizzard in jeopardy after blocking the deal. We'll discuss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Danny Berger in London. UK regulators have blocked Microsoft's $69 billion purchase of Activision Blizzard over concerns it would harm cloud gaming competition. The companies plan to appeal the decision as they try to salvage the biggest ever deal in gaming. With us now is Bloomberg's Alex Webb. Alex, what exactly are they worried about? So it's not necessarily games on the consoles themselves, but it's the cloud. What are their thoughts there?
So, yeah, cloud. So console gaming is very much the model we're used to over the past 20, 30, 40 years, where, yeah, you sell a game, play it on a console, boom, off to the races. The new model that is really evolving is cloud gaming, often subscription-based, where you might pay clearly a certain amount every month, and you get through that access to a whole bunch of different games. It's something that Microsoft has been quite bullish about. It's sort of a medium to long-term play, built on Azure, on their cloud. You suspect, therefore, that what's happening with regulators is they are trying to ensure they avoid the mistakes of the past. When Facebook bought WhatsApp, when Facebook bought Instagram, they weren't necessarily massive competitors to Facebook. But in hindsight, regulators suspect maybe they could have become competitors. Similar with Google and DoubleClick. So what they're doing is making a decision early in this race to try to prevent market concentration.
But why is this a fear? I mean, can't Microsoft just say, all right, it won't just be available to download on our cloud store? Other gaming companies can do this too. Why are regulators picking on this?
So one of the concessions that Microsoft offered was to make it available for a certain number of years, make things like Call of Duty, which is made by Activision Blizzard, available for a certain number of years to its competitors in the cloud. The challenge with that is what happens after a certain number of years, often sort of 5 years, goes quicker than people will imagine. And secondly, it's something that the regulator will need to keep an eye on, right? It requires further regulation, which is a bit of a burden they don't necessarily want to take on.
So what next? Can they successfully appeal this?
Well, they can appeal. Whether they can successfully appeal is the big question. There's not a great track record of companies appealing CMA decisions. The other thing, of course, is we're yet to hear from US or European regulators. There's a possibility they might take a similar tack, in which case it would render perhaps an appeal in Europe, sorry, in the UK, sort of moot if the decision across the board is to block this.
Yeah, Chris Hughes has a really good opinion piece where he says something like, you know, think again if you want to do M&A in Britain. So it's interesting to think also about the chilling effect perhaps on M&A in this country as well and regulation there. Alex, thank you so much for joining us. That is Bloomberg's Alex Webb. Now later today on the European Close, we're going to be hearing from the CEO of Activision Blizzard. That's Bobby Kotick. That's going to be at 4 p.m. UK time, 11 a.m. New York. Well, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Anna Edwards. This is Bloomberg.
Bank earnings have actually been quite solid. Deposit flows have steadied quite a bit. I don't think that this is really a crisis of confidence, but I do think it's likely that we continue to see some jitters, especially around some of these names.
Ultimately, it's not systemic in terms of a major run on the bank. The bigger question is, what does this do in terms of financial conditions more broadly?
Higher interest rates are going to slow things down. If we see credit tightening on top of this because of what's happened in the banking sector recently, I think that all points to a recession.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Meta buys itself some time. A surprising digital ad sales rebound will let the Facebook parent keep pouring money into artificial intelligence and virtual reality. First Republic's standoff, it's stuck between US regulators and its largest rivals, both of whom hope the other steps in to save the troubled regional bank. And two of Europe's biggest banks report earnings. Deutsche Bank is ramping up cost cuts, while Barclays rises after beating expectations. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, once again, we see this push and pull between sentiment from the banking sector and sentiment on tech. For the moment, US futures pointing higher on the latter of those, on the tech themes.
Yeah, that's right. And we really have seen that divergence boost the NASDAQ, for example, yesterday in the cash trade, while the S&P falls. So tech really a big part of this trade. But yes, the First Republic concerns are really weighing on the market. Right now, the S&P futures are up about 0.5%, and you do see 10-year yields coming up a little bit. That means that investors are selling that debt at 347.30. We're about 7 basis points higher than we were at the same time yesterday. NYMEX crude, on the other hand, has come down pretty substantially. We're up 14 cents in the session, but yesterday, remember, we were looking at $77, $78, and now we're looking at $74.44. So real concerns about the demand side of the equation outweighing any kind of supply constraints that OPEC Plus and others can put on. Bitcoin continues to rise closer to $30,000. We're almost at 29 again, 28,970, up another $550 or 2% today. Of course, it's heavily correlated to the tech side of things. So when you have Microsoft doing well, when you have Meta doing well, you get a pickup in Bitcoin as well. Take a look at what's going on in Asia. In terms of the broader market, you had a slight gain, 0.1%. Chinese stocks are doing a lot better, though, than the other indexes in the region. The CSI 300 up about 0.75%. I wanted to include Samsung here because they came out with earnings that disappointed for the current quarter, but an outlook that was more upbeat. So the shares initially fell in the session more than 1%, and they have come back to the close about 0.8% higher. So obviously, this is going to be connected to chip stocks in the U.S. and in Europe as well, in the U.K. as well. And then the yen, right now not doing a lot at 133.87. The dollar sees a little bit of strength against the Japanese currency. But the Bank of Japan kicked off its first meeting under its new governor, Ueda, and tomorrow will actually get the decision. So watch this pair as well as the yen paired against any others. What do you see going on in Europe, Anna?
Yeah, well, here in Europe, Matt, we're dealing with that twin push and pull, as we mentioned, around technology and financial services, and also the earnings stories domestically, or at least European generated. Add that on top. So this is the picture in Europe, fairly positive, just into positive territory on some of these markets. The FTSE 100 entirely flat, but actually European markets eking out these gains after we saw losses earlier on. Earlier on in the trading day, we were much more weighed down by the nervousness around the banking sector over in the United States. We're managing to put that to one side. The technology story here in Europe, though, is more mixed, is more nuanced than maybe the mega cap story out of the likes of Meta would have us believe. This is the picture for ST Microelectronics, for example, Matt, and you went through the Samsung story there. That in itself was a little mixed. ST Micro down by 7.5%, even though the numbers came in better than expected. The company upgraded its guidance, but for many analysts, this wasn't new enough information about the company or the sector, and as a result, the stock has sold off. Barclays in the financial services space in London up by just over 4%. The numbers there, in particular from FIC Trading, they helped to offset, they were strong, they helped to offset some weakness in the equities trading side of the business and the M&A from fees and investment banking. There we saw, just like many other banks, that was a little lackluster. We'll get more on the Barclays story for you shortly. Unilever up by 1.3%. The fast-moving consumer goods business saw volumes at surprisingly high levels, despite the fact that prices are rising. Consumers are prepared to tolerate those higher prices, to pay up for them, and they're not seeing down trading into cheaper brands, which is interesting. Universal Music Group down by 3.9%. And what was interesting here is this is another story of a beat this morning, Matt, but another story of a beat that wasn't enough. So the numbers came through from Universal Music Group better than expected, but apparently it was the physical market rebounding, CDs in Japan and vinyl in Europe and the US, and analysts deemed that to be unsustainable, and as a result, the stock is weaker.
Yeah, it's interesting you're seeing kind of a mirror image there of what we've seen here, right? Because you have tech stocks down, ST Microelectronics off, and bank stocks up. Barclays and Deutsche Bank doing quite well. So at least for the time being, you've got a reversal of the push-pull that we have seen here. Let's take a look at big tech after Facebook reported, or Meta as the parent company is now called. Quarterly revenue and user growth both beat estimates. The company's surprising digital ad sales rebound is buying it time to keep pouring money into artificial intelligence, a real buzzword for this earnings season, and virtual reality. Not so much. CEO Mark Zuckerberg spoke on generative AI on the earnings call.
I think that there's an opportunity to introduce AI agents to billions of people in ways that will be useful and meaningful. That's been a pretty amazing year of progress on this front, and The work happening now is going to impact every single one of our apps and services.
Bloomberg's Alex Webb joins us now for more. So, Alex, Facebook growing again after some cuts and controls on the cost side.
Yeah, that was really what has got investors excited. This has been heralded by the company as its year of efficiency. They've been cutting 17,000 jobs over the past few months. That has prompted a real resurgence in the share price. What we're seeing now is actually growth on the top line. And that means that it's good news on two fronts. It does give them some scope to invest in some new products, but it was also very interesting that we've seen a shift in the tone of the conversation. Talking a little bit less about the metaverse and a little bit more about AI.
Yes, that was interesting, wasn't it? So, and the insistence coming through from the management that they are still focused on the metaverse, and yet colleagues counting the number of minutes dedicated to talking about these things say that the call was much more focused on AI. What about the competitive environment? So, for example, against TikTok, I know that Meta's been all about Reels recently. How's all that going on?
Well, they're saying they saw a 25% increase in engagement on Instagram, which is clearly good news for Facebook. They are also prepping a new product that's being reported in some circles, which will compete more directly with Twitter in the hope of hoovering up some of the discontent Twitter users. Look, engagement on Instagram, it tends to keep people on the platform more than it does on Facebook. People are more likely to click out of Facebook to go to places elsewhere, so it can be quite lucrative. I think the bigger story than those product-specific things is just generally the uptick in ads. There was conversation yesterday around Google, Alphabet, the parent company of Google, that ads had seen a recovery at Google, but YouTube hadn't been as good. That caused a little bit of concern looking towards Facebook, that maybe, well, Facebook is more comparable to YouTube. What we've seen today or overnight is that that is not really the case, and that Facebook has been benefiting from the tailwind too.
All right, Alex, thanks very much. Alex Webb there, wrapping up the tech side of things for us. Let's get back over to the banks, because Deutsche Bank pledged to step up cost savings after its traders trailed Wall Street for a second straight quarter. The CFO, James von Moltke, spoke with Manus Krenny about the impact recent turmoil in the sector has had on DBK.
In the last couple of weeks of March, our view is perhaps 1%. We saw of that 4%, 1% in that period. Interestingly, once March was over and we were into April, like a light switch, the concerns around the banking industry went away, and we've seen deposits stabilize and grow over the course of April. I'd expect that we'd be back over 600 billion by the end of the month, and I think confidence has come back into the sector.
Manus joins us now then from Frankfurt. So, Manus, what do we know from James von Moltke from Deutsche Bank? It looks like investors are pleased with the results.
Well, in the first sweeps, yes, Matt, and a very good day to you. What you're seeing is liquidity buffers being built at Deutsche Bank. An investment bank, however, which is down there at the lower echelons, down 19% on the quarter. But the core of Deutsche Bank, which is the retail banking arm, the corporate lender, is on fire. It's cranking it out there. Over 30% growth in the quarter at the core bank. So the question that goes through my mind, are we at peak interest rates or near peak interest rates and peak NIMs? Peak investment bank, part of the huge turnaround story at Deutsche Bank. And when it comes to that narrative, he pushed back very clearly that he wouldn't think that that's the top or the peak in the turnaround in the Deutsche Bank story. On the flow show, 29 billion went out. 2/3 of that was normal, flipping into money market funds. And then, as he said, the light switch came on in April. Things calmed a little bit for them. 12 billion came in terms of asset gathering to the private bank and to wealth management. And you can be sure they're tapping on the doors of every wealthy family and client around Europe. It's one of those moments that will endure in this story. And they've changed the language on the buyback. They are now initiating discussions with regulators, and that's what the market has been banking on. A little bit cautious in the tonality. Maybe the Credit Suisse debacle and the UBS pausing on the dividend has given them cover to extend and pretend on when they deliver the buyback. Anna, Matt.
Yeah, the Deutsche Bank share price up by 2.3% then on that news. Manus, thank you very much. Manus Krenny in Frankfurt. From one bank to another, Barclays has beaten expectations in the first quarter with a surprise increase in fixed income revenue. That offset falls in equities trading and in deal making. Bloomberg's Francine Lacqua sat down with the CEO for an exclusive interview. He said he's confident for the next quarter despite the recent banking turmoil.
I think the Credit Suisse was a very specific case. While I think Silicon Valley Bank was a specific case in terms of its circumstances, it has highlighted an issue with some of the regional banks in the US. And that we will see continuing to play out maybe in a small number of names. And we've seen First Republic over the last couple of days. So I expect that we will see over a small number of names. It's not going to be systemic in any way, but there will be repercussions.
So not systemic is his verdict. Francine Lacqua joins us now with more. Francine, good morning. So a good set of results then from Barclays, judging by the share price reaction. FIC traders doing what they're paid for. Can they keep up that momentum?
Yeah, so we really asked him multiple times to see whether this is a trend that he thinks will continue. Now, he says, look, it's not really a hedge because they've tried to build the business, and he took immense pride in saying these set of results were also some of the changes that they put in place over the last 18 months or so. So he says, look, FIC trading, which is a big part of what they do, equities disappointed, not a huge part of what they do, will be there as a buffer. So I don't know if it's a natural trade, but he really wants to work on all of the levers, all of the drivers going forward to make sure that whatever the economy throws at him, this could be either a credit crunch or a consumer, though he was pretty confident that they will hold because he's already seeing a pattern of changing behaviors, that they can, change that and put money where it needs to be. It was also really interesting to get him on deposits. So he said he saw about $10 billion in deposits in the quarter, and that's also because of a change, I guess, of heart because of SVB.
I thought you made a great point about the importance of diversity, and he backed that up. I also thought it was really interesting, Francine, his view on working from home. He's been working from home as he battled cancer, and now he's come back to the office. And I thought his take on the consumer was really fascinating, that the consumer is really pulling back, but not really suffering, still doing quite well.
Yeah, and you're right, Matt. Good morning. I mean, it was really actually quite touching to see so much energy from someone who's been through a lot. He's never actually stopped working, but he says he wasn't really working at full capacity like he's now. When he talked about the hybrid working model, he says, look, he had to work from home because of his illness for many months. And he says it's a very different perspective where everyone else is in the office. So he really, and you could see it was palpable, the energy that he had from meeting with his team and kind of meeting in person. On consumers, he did see, Matt, there was a change in consumer behavior, certainly here in the UK. Nothing huge, but actually he says there's more savings and people, of course, trying to save money also by trading down in what they spend. If you look at Barclays card, it really gives you a good sense of what the consumer does in, I guess, the next month or so. And he says for the moment there are headwinds, but, consumer spending remains pretty strong.
All right, Francine, fantastic interview. I recommend anyone who didn't see that go to Bloomberg.com and check it out. Francine Lacqua, an exclusive interview with the Barclays CEO, Venkatakrishnan. We're going to show that, a little more of that later on this hour and throughout the day. Now, First Republic, speaking of banks, but focusing more on smaller regional banks in the U.S., the stock was halted 16 times during yesterday's trade as the price continued to drop. U.S. regulators are said to be weighing limiting the bank's access to borrowing from the Fed. Bloomberg's Valerie Teitel joins us now for more. So, Valerie, is there any sign of a rescue deal for First Republic, either from regulators or from the big banks that deposited $30 billion with this regional bank?
Yeah, is it going to be a private or public rescue deal? It seems we're just waiting for another big bank to come in and swoop up First Republic's assets. And it's more likely to happen the lower the share price goes, that some bank out there will find value in their assets. But they've been struggling to find a buyer for weeks. And possibly a potential bidder is just hesitant because they want the government involved in order to protect them from some potential losses in the loan book. But the regulator from the FDIC, they seem in no rush to put the bank in receivership. They don't want to do that because they want to avoid taking yet another loss to their insurance fund, and they really want a private rescue instead. So it's become a bit of a standoff between the FDIC and the wider banking industry.
Yeah, I really recommend Matt Levine's piece on the Bloomberg Terminal talking about what it means for various players in the sector, regulators and other banks, depending on how this is resolved. The other risk that the market is weighing up then, Valerie, is really around the US debt ceiling drama. What's the latest on the deadline?
Yeah, just another potential growth that the market and the Fed has to deal with when they meet next week. Now, there's been a sudden acceleration in tax receipts. This means that the recent approximation for the X-date, for the date of default, has been pushed out to late July, possibly early August. Now, we should hear from the Treasury some point, maybe later this week, maybe next week, on what their official assumption is for the X-date. Now, earlier, before this recent acceleration in tax receipts, we thought the date could be early June. Now, is more time a good thing or a bad thing? It's really not clear, but for the markets, it's just another risk event looming large that they would rather be over.
All right, Valerie, thanks very much. Bloomberg's Valerie Titel talking to us about really the most important stories for the market today. Meanwhile, there is no sign of any compromise in the partisan battle in Washington, D.C. over extending the debt limit, something that really hasn't hit the markets too hard just yet. House Speaker Kevin McCarthy's debt limit bill has squeaked through, but that's put pressure on President Biden to open talks with the GOP to avoid a payment default this summer. But the president has signaled he won't give in to Republican demands. McCarthy spoke after the bill passed.
Now he should sit down and negotiate. We passed this early. We are in April, way ahead of the debt limit. We just passed the bill. It's not our job to modify it. The Senate could pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
That's the latest on the debt ceiling then stateside. Coming up on the programme, Skylar Montgomery Koning joins us, Senior Global Macro Strategist at TS Lombard. What does she make of the rates environment right now? How does weakness in the regional banking sector in the United States weigh in onto the Fed conversation about where rates go? What does that mean for bond markets? We'll discuss all of that. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York with Anna Edwards over in London, and we are waiting for some inflation data here in the U.S. On a number of fronts, CPI as well as ECI, and some things that the Fed looks very closely at. In the past few months, when we've gotten this data, you see a ton of volatility before the number comes out, and now we see that happening less. Of course, April has seen far less volatility, but we've got a new gauge. The VIX one-day gauge is what we're looking at here. Joining us to talk more about it is Noor Al-Ali, Bloomberg Markets Live editor. Noor, we look at this and we're excited about it because a lot of people think the VIX is broken, and many investors have gone to 0 days to expiry options instead to hedge.
Yeah, absolutely, Matt. And you're absolutely correct. I think, and I talked about this a few days ago on the blog, what it really implies or it shows that there's a structural shift in the market. We had some data that showed about 40% of the S&P 500 options have actually shifted to the 0 day options. And that really is a reflection. I mean, even if you have the VIX, if you look at it from a short-term volatility as well, you look at the 9 day, you'll also see that trend there. But it really, what it shows us as well is that perhaps there is much more risk priced into the market than investors are seeing.
Okay, and take us to the yield curve as well, Noor, because I know that you've been writing about this recently, talking about the yield curve steepening and some in the market seeing room for it to steepen further if we're going to see, short-end rates coming down to reflect an expectation of cuts. Is that what people anticipate?
Absolutely. And look, historical performance, I mean, this is the caveat, is not a reflection of future performance, but we can look at trends and we can infer that in the last, I've got like maybe some 3 examples today that I've talked about in the blog here. You look at it in the 1970s, you look at it in the late 1990s, and even in the 2008 financial crisis, and you'll see that there is often a re-steepening of the yield curve, particularly after an inversion that comes in ahead of a Fed interest rate cut. And obviously, a lot of people talk about, well, that is a greater indication for a recession, and that's what we're looking at when we're talking about the yield curve.
Okay, we're alert to that. Thanks very much, Noor Al-Ali of the Bloomberg Markets Live team. She mentioned the blog. You can find that at MLIV Go. That is the Market Live blog, available on the Bloomberg terminal. This is Bloomberg.
Coming Coming up, Skylar Montgomery, Koning, senior global macro strategist at TS Lombard, joins us. And there's a lot to talk about. As Anna said, there's really a push and pull between concerns about the banking sector and optimism for big tech. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Meta buys itself some time. A surprising digital ad sales rebound will let the Facebook parent keep pouring money into artificial intelligence and virtual reality. First Republic's standoff. It's stuck between US regulators and its largest rivals, both of whom hope the other steps in to save the troubled regional bank. And two of Europe's biggest banks report earnings. Deutsche Bank is ramping up cost cuts, while Barclays rises after beating expectations. I'm Anna Edwards in London with Matt Miller in New York. And the focus here in terms of banking is on the banks reporting. And all of that, so far so good, seems to be going pretty well for the banks that are reported today, Matt. The focus for you guys in terms of banking still on those regionals. And we thought we'd left that topic behind in March, but it seems it's back with us.
It's come roaring back, right? I mean, Ben Emmons over at New Edge Wealth writes about FA flight, so financial advisor flight, and that's a new thing that First Republic has to worry about as we wait to see who rescues them, right? Is it going to be a public or a private rescue? I think it's really interesting. Right now, we're looking at S&P futures that are gaining, but this kind of push and pull that you've highlighted is what we've seen over the past few days in this market. Tech stocks doing really well after reporting good earnings. And as a result, by the way, NASDAQ futures are up even more. I don't have them here, but they're up 0.8% right now. And bank stocks in really financial services doing poorly. And you've got that split in Europe as well, right? Because the banks are up, financial services are down. The U.S. 10-year yield is just barely moving higher in today's session, but we're up 5 or 6 basis points from where we were at this time yesterday. Right now, 345.60. That doesn't seem like it's going to be enough to give stocks a run for their money. And it does seem like if investors are letting go of the 10-year and of U.S. debt, of zero risk debt, that they're willing to go into stocks. NYMEX crude is rising 19 cents. WTI, though, yesterday was at $77, $78. So now we have a 74 handle on WTI. And the same is true for Brent. It moved down in yesterday's session and is recovering up a little bit today. This is because of concern for demand. It hasn't really shown itself, and the supply constraints that OPEC Plus have come on aren't helping to move the price much higher. Something we talked a little bit about to Fatih Birol yesterday. And then Bitcoin up $500. Obviously, it's highly correlated to the tech stocks that are doing so well, but it's climbing back towards 30,000 after dipping below 27 briefly. It's at $28,928. Take a look at some of the movers in the market. Meta obviously is going to be a huge one. It's poised to add $61 billion of market cap if we see it gain by 11% in the cash trade. And by the way, analysts love this stock now. It has 46 buys and only 5 sell ratings, as well as an average price target of over $250, right? And the stock is up 74% year to date. Mark Zuckerberg has kind of turned the page, and he's now focused on cutting costs and generating profits, and that's what the market wants to see. Snap is also up about 3.6% in the pre-market. It reports later today, but we've seen great stuff from other tech companies, so we're waiting to see what we get from this. I think of it as kind of a kids app, but of course the kids that use Snap are millennials and now like approaching their 40s. First Republic is the problem child of U.S. regional banks, and it has been absolutely crushed over the past couple of trading sessions again. This is a bank that traded for $175 just a few months ago, and now it's trading for $585. Real concern about obviously deposit flight. We learned of $100 billion leaving First Republic out of only 173 to begin with in the first quarter. And now we're talking about financial advisors just taking their whole business, clients' money and leaving. So that's a problem. Stellantis is doing well right now, up 1.6%. The maker of the Dodge Challenger Hellcat is cutting costs. It's offering buyouts to 33,500 U.S. hourly and salary employees. Of course, it's going to move on from the 6.4-liter Hemis to battery-powered cars, which take far less, which require far fewer people to put together. And then Wolfspeed is a maker of semiconductor products. It's down 14% in the pre-market. It used to be called Cree, C-R-E-E. It forecasts revenue in the fiscal fourth quarter, which is this current quarter, that missed analyst estimates. And people are watching chips so closely, Anna, so this is a key one to watch. What do you see in Europe?
Yes. Yeah, well, one of the things we see in Europe is what you pointed out last time we checked the markets, Matt, which was the sort of opposite push and pull to the United States. So whereas you've got tech going higher on the likes of Meta, we've got tech coming down because of that concern around chips. And here's the ST Microelectronics story supporting that, down by 7.5% or so. And the numbers were better than expected, but it seems that the guidance, even though they upgraded their guidance, it wasn't new information for the market. And so some decided to take some profits there. We also see the opposite trade to you in terms of banks. The story in the US around banking is focused on the regionals. There's concern there in particular. How ring-fenced is that? How idiosyncratic is that to one particular part of the regional banking space? Well, here in Europe, the focus is on big banks, the reporting season. That's going pretty well. Certainly fixed income traders doing well at Barclays, pushing up that share price up by 4.5%. That leads to this overall picture of not moving anywhere very fast, up by 0.2% this Thursday as we digest a lot of earnings reports here in Europe. It has been a really busy morning for earnings. And another one of those earnings stories is Unilever, up by 1.7% for the consumer goods product business, and they've managed to push up their volumes more than the market had expected. So even though prices are going higher, consumers are paying up for those, it seems, and consumers are not trading down, according to the CEO, to cheaper brands. That's one of the observations that he gave us this morning.
All right, let's talk about all of this with Skylar Montgomery Koning. She is a senior global macro strategist at TS Lombard. And Skylar, you know, before we get to the success, the optimism around big tech this earnings season, I want to talk to you about the bank turmoil. I won't use the word crisis, but the turmoil we've seen here in the U.S. We thought it was in the rear-view mirror. Now we see problems again with First Republic and some other share prices moving in sympathy. Is this idiosyncratic? Is this a First Republic-specific problem, or are you concerned about banking in the U.S.?
I mean, I will say when the crisis first happened, we did say it wasn't systemic, and I think that's still the view. But I'll also say that the SVB drama, it's made investors more aware of banks' funding and asset credit risks. So with the current market panic dealt with, for a large part, I think, these risks, they will take longer to become fully visible. It's more of a slow burn on bank profit margins. And a point to note is that bank funding costs are now set to rise. So depositors now have a better alternative with higher yields in money market funds and short-term interest rates. And competition for deposits, that will pose risk of outflows at banks that are too slow to raise deposit rates. And that makes potential liquidity events more likely. And that higher deposit, you know, that cost squeezes margins. There's also now a focus on exposure to highly interest rate sensitive sectors like tech and commercial real estate. And the credit tightening that is coming, you know, that will weigh more heavily on these industries. So, you know, finally, I think banks, you know, there are highly cyclical sectors, so slowing global growth also weighs. So maybe not a systemic risk, more idiosyncratic to First Republic, but definitely banks are under more pressure than previously.
Skylar, I wonder how much, you know, how closely is the Fed watching this? Because everyone kind of expects one more increase and then a pause. But I don't see any reason for a pause, right? They haven't beaten inflation yet. And they haven't really broken anything. We've had, you know, idiosyncratic, as you pointed out, issues with certain banks that raise issues, but it's not like financial stability is in question yet. So how does the Fed play this?
Yeah, I mean, I think I actually have to disagree with you there in terms of I think the Fed now, I think the Fed now, they're truly data dependent. You know, the next meeting will likely get a 25 basis point hike because a lot of the angst has come out of the market. But, you know, the SVB crisis, that's doing some of the tightening for them. Unfortunately, though, that tightening impact is unknown, and it's likely to be more volatile than just another 25 basis point hike from the Fed. And I think the market focus now, it's very much on, you know, the magnitude of cuts in 2023 and 2024. And the market's able to focus on cuts because the key is that inflation peaked in the summer. And it's been declining since then. So inflation surprises are actually negative now for the first time since 2020. Inflation's falling, and you know, the financial turbulence has given them room to not guide higher. You know, they're still trying unsuccessfully to convince the market of higher for longer. But, you know, I agree with the market that the Fed will be forced to cut, and our expectations are actually more dovish than the market. So we think that the Fed will cut to 2.75% by the end of 2023. You know, we're on the path to recession, and usually when the economy enters a recession, it happens quite quickly. The move tends to be non-linear. When the economy goes into a recession, the Fed historically cuts quite deeply. But even, you know, what's more is that as inflation falls, if the Fed does nothing, they actually are doing higher for longer. You know, they're engaging increasingly high real Fed funds and tightening. And I just don't think that happens with unemployment rising.
Okay, well, if we do get to cuts quicker, then I don't know, is that good for the tech sector? It's certainly, you know, higher rates wasn't great for the tech sector, but somehow it managed to turn sentiment around. When we all started worrying about the banking sector, the tech sector started to have a good time of things. Right now, Skylar, we're dealing with these very contrasting themes within tech. There's the sort of mega tech in the US where things seem to be pleasing to investors, and those stocks go higher. But there's a lot of concern around the chip space here in Europe, in Asia, and elsewhere. I mean, how do you pull these things together?
Yeah, I mean, I think we're seeing a natural rotation this year versus last year. So last year was the year where we saw higher rates. That meant that, you know, what's considered typically duration didn't do very well, and tech was included in that. And so now we're not only seeing what was underperforming last year outperforming this year, but also because the market is seeing cuts and it's seeing the peak in the policy rate that we'll certainly get this year, even if you debate, you know, when exactly we get that peak and how many cuts you get after. We're certainly getting that peak in cuts at some point this year, and so that's seen as being more positive for these sectors. I think, you know, generally, I actually think the risk asset resilience is justified, even though I see this recession and the cuts coming. And I think part of that is because liquidity has turned more positive. So if you look at the central bank liquidity impulse on a 6-month basis, that's turned more positive. You've had economic resilience, and all of this is feeding into these sectors. And naturally, you're going to see a flow into tech because it's the largest component of the S&P.
Yes, and therefore it maybe sets the pace. So maybe that answers my next question, Skylar, which was where do stocks in general go when we see the US go into recession, when we see the Fed to start cutting rates? What is the timing of those and the stock market moves?
Yeah, so I think, you know, equities, as I said, they've been holding up very well. Part of that is that the end of the Fed tightening cycle in sight. And, you know, what we saw in the market was the initial panic over SVB and the banking crisis. Then the market realized that there wasn't a huge amount of contagion. It wasn't a systemic banking crisis, and you have some of that over-exuberance undo. But, you know, the biggest read-through to the U.S. economy was that the risk of a hard landing had risen, and that meant Fed cuts. So you got a massive rotation into these sectors. You know, we've also gotten, you know, this recessionary impulse increase, and I think now equities are starting to come around to this idea that the bad news is bad news, and that credit conditions are tightening to the detriment of the economy. And I think that makes sense. So that's why you're kind of stuck without being able to go higher or lower, because, you know, historically, you've never had a bottom in the equity market without the corresponding recession begin. Now, you know, this is one of the most anticipated recessions in history, and so you could argue that it was well priced in beforehand because the recession is essentially being caused by the Fed. But, you know, I think we're caught between these two counteracting factors, and so we're actually neutral equities, and I think it makes sense. You know, equities are also very dependent on nominal growth and earnings, especially when you don't have easy money. So investors, you know, they could look through a mild recession.
Skylar, thank you so much. Thanks for your time. Skylar Montgomery Koning of TS Lombard, thank you very much for joining us. Coming up on the programme, Meta's earnings beat. It sets the stage for more tech results due later today. More on the tech sector next. This is Bloomberg.
That slowing hiring, flattening our management structure, increasing the percent of our company that is technical, and more rigorously prioritizing projects will improve the speed and quality of our work. I also believe that a stronger financial position will enable us to weather a volatile environment while remaining focused on our longer-term priorities.
Mark Zuckerberg there, of course, the CEO of Facebook parent Meta, speaking after the company reported quarterly revenue and user growth that beat estimates. Joining us now is Bloomberg intelligence analyst Matt Blockbuster. Matt, let's dive deeper then into the numbers that we got through here and where the surprise came from. The positive surprise was really on, on revenues, on ad revenues. What's the driver there? Does it tell us anything broader than just Meta? Is also an interesting thing to think about.
It probably does, but I think more specifically, it really is a kind of Meta recovery story. They spent all of last year struggling with rivalry from TikTok and adjusting to Apple's changes in privacy, which really hit their ads business hard. So I think this quarter is a very clear signal that we've got things back under control and we're starting to get good momentum again. I mean, revenues only grew about 2.5%, but after 3 quarters of decline, that was a good turnaround. And I think it's the Reels product, which is their short-form video product, which has started to get better traction. It's helping viewing time on Instagram, and they're getting better monetization against that. It's still not monetizing as well as their legacy products, but it's on track to get there maybe next year. So I think encouraging signs that things are back under control in the part of the business that makes all the money.
It's so weird that Vine turns out to be the killer app that makes money for Facebook. I wouldn't have believed it 10 years ago, and I still don't get it. But how does AI play into their strategy? I mean, everyone's mentioning it. Everyone has to talk about it. I feel like, every CEO's flack makes sure that there's a paragraph about AI in the earnings release. But what does it do for Facebook, for Instagram?
Yeah, and same for Facebook. They spent 90 seconds talking about the metaverse and 6 minutes on AI. Amazing. So I think for them, it's kind of the moment sitting in a bit in the background. And the way Mark Zuckerberg described it is that AI is helping them to serve the right content to their audience at the right time. That means they're getting better engagement, and it means that they're getting better traction in terms of the ads that they're serving, and so brands will want to spend more with them because they know they're going to get a better return on it. So at the moment, it's just kind of helping the business be more effective and efficient. We might see them put things into the front end. Mark Zuckerberg said AI is applicable to all of their products. This morning on Snap, I got a new friend, if you like, which is an AI chatbot that they've just launched. So I'm expecting to see something similar on Instagram or WhatsApp maybe sometime soon.
Okay, do let us know how that friendship develops, Matt. We'd be interested to know. We heard from the CEO, we heard from Mark Zuckerberg talking about the prioritisation of projects.
Yeah.
Is the management's vision aligned with the street right now or not? Or is it just that because of the uptick in ad revenue, the street's going to make less fuss about a misalignment of visions?
Yeah, I think that's probably it. They're still very clearly committed to the metaverse as their North Star. I mean, the losses this quarter were close to $4 billion of their investment in Reality Labs. So I think there is a big mismatch there still. And I think, the street's patience with those heavy losses isn't going to last that long. But yeah, it's an easiest pill to swallow when the core ads business is performing respectably.
OK, Matt, thanks so much. Thanks for bringing us the analysis. Matt Blockbuster of Bloomberg Intelligence. Coming up on the programme, Barclays bond traders helped drive the bank to a profit beat, helped drive the share price higher. We'll bring you part of our exclusive interview with the company's CEO next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. On to banking, and Barclays traders surpassed expectations in the first quarter with a surprise increase in fixed income revenue. The bank's CEO spoke exclusively to Bloomberg's Francine Lacqua.
It was a very nice set of results this morning that we were privileged to publish. What I liked about the results, Francine, is not just the numbers, but the composition of it. And FIC was an important part, but not the only part. So if you look at the numbers top line, 2.6 billion of profit before tax in sterling. It's about up 16%. Revenues up around 11%, 7.2 billion pounds. An excellent ROTE of 15% across the group. Capital ending where we would like it to be. One of the, a record quarter of performance for the bank, and the second biggest for the corporate and investment bank. So all very good. Now, what drives it? And that's the important part. And for us, it's actually been the workings of many, many quarters of building this. And there are 2 parts I'd like to highlight. The first is the investments which we've made in our business. whether it's in our credit card portfolios in the US, where we acquired a Gap portfolio of 10 million customers, and whether it is in our markets business, where not just investment in technology and people and fixed income, but also in our trading systems, but also in financing, both in fixed income and in equities prime, which continue to help us in this environment.
So if you look at FIG trading, are you expecting this momentum to go into the second quarter?
So we hope to keep the market share that we have gained with our clients over a number of years to persist. We've broadened and deepened relationships. The actual dollar amount of revenues, of course, goes up and down with volatility in the markets, and that's much, much harder to predict. But what we try to do is to have that capability.
So is this a kind of diversification from the rest when you look at your main drivers going forward?
Well, what we hope is that we have a lot of drivers, and that at the right times in the market, that they all are there and they click. So, you know, the first quarter of this year was a lot about the bond markets. Interest rates went up and down with the stuff in banking that happened in the US. The first quarter a year ago was about equity vol, single stocks. And then our equity business was ready to capture that. So that's how we try to do it, have a full-fledged capability.
So when you look at March was pretty incredible when you look at the banks, starting with the SVB and then Credit Suisse. Does that mean that you had deposits, that people come to you because they were afraid of other banks?
So the UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually people, corporates, putting deposits with us. On the consumer side, it dropped a little, but that seasonality we expect as people pay their income tax bills and draw money from their accounts to do that. So the deposit franchise has behaved extremely well and predictably, but it's also, for us, it's a deposit franchise that we've built over decades, right, with a very nice mixture of individuals, of corporates, small businesses.
An exclusive interview there with CS Venkatakrishnan talking to our colleague Francine Lacqua. And interesting that he doesn't see the US banking turmoil matter systemic.
Yeah, I mean, of course, it's good that he says that for the whole industry, right? If he did see it as systemic, his share price might not be doing nearly as well right now. But I thought it was also really interesting, his take on the consumer, which started out this interest rate hiking cycle much richer and is now not nearly as damaged as it could have been otherwise.
Yeah, no signs of distress. One of the ways he characterised the UK consumer right now, and he has great insight into that. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.